narrator in this podcast series. I've been an entrepreneur, investment banker, and board leader for about 25 years. Today we have about 25 registrants for the event. Thank you all for joining. Family business is a passion of mine, having grown up in a family of entrepreneurs and engaged in a wide range of dialogue in business with fascinating family enterprises around the globe for 2 decades. I founded the Family Business Podcast to provide a valuable platform for listeners to hear from veterans, academics, and leaders in family-owned businesses, enterprises, and family offices. Whether you're a seasoned family business leader or building a family office, these conversations are sure to be enlightening. Today, we have a special episode focusing on the wealth management side of the family office and the family business, with a particular emphasis on the utilization and power of artificial intelligence, with one of the leading advisors to family offices and their long-term wealth. Family business is a subject close to my heart, and I'm excited to delve into these topics with our esteemed guests. Today, we welcome John Bailey, founder of Lumenai. John, it's great to have you here, my friend. Thank you for today.
Adam, thank you for having me. I appreciate it, and I look forward to our conversation.
I'm going to brag about you for a bit, and then we'll dive right in.
Feel free.
John is the founder and managing partner of Lumenai Investments, and this business is at the forefront of revolutionizing hyper-custom investing through data science and artificial intelligence. Lumenai caters to family offices and advisors and institutions, provides them with tools to construct highly tailored, alpha-oriented investment portfolios transparently and efficiently, and typically at lower overall cost. From classic long-only portfolios to also complex hedge fund strategies, Lumenai's aim is to simplify portfolio management using data science and AI, saving its clients valuable time. Lumenai was just recently named to the AI FinTech 100 and the Wealth Tech 100 lists, acknowledging the firm as one of the top global firms employing AI and technology to overcome investment challenges. I've known John for a long time before he was the founder of an outsourced investment office and MFO called Spruce, and there he emerged as an early pioneer in alternative investments across the whole spectrum, and also was the CEO of investing for a private family office prior to that. He's been around the community for a long time. So, John, let's dive right in. Thanks for joining us today.
Thank you, Adam. I appreciate it.
So we'll have about a half hour here. Let's start with your background a bit and what brought you to launch Lumenai, and then we'll talk a bit about the different types of family offices as your client base.
Sure. As you alluded to, I started Spruce back in 2000, and we were an outsourced investment office with an emphasis on alternative investments. And we spent a lot of time traveling around the world, searching for and visiting the best hedge funds and private equity and real estate managers that we could find. We would do asset allocation, and for public markets, we would invest in low-cost ETFs. So passive investing. So it's kind of the passive plus the alpha together. And that was a great process, and it was overall we were very successful over the long run. But we noticed things were changing, and what we noticed was a lot of the fundamental players really started to struggle much more. This is especially after 2008, when financial markets, government interventions, were changing the rules. But we noticed some of the best players that just continued to really succeed were quantitative managers. And if you think of the hedge fund world, many of the largest and most successful hedge funds are quantitative. So World Quant and D.E. Shaw, and Two Sigma, Renaissance Technologies, and firms like that. And so we morphed from kind of the analog, by hand, asset allocation, manager selection process to adopting data science and AI, especially as computerized trading and cloud technology and AI technology has gotten better and better. So now we've morphed over into what we think is actually a much better, easier, simpler, more efficient, more scalable process to invest capital.
That's great. Now, where are you guys today? I love the name Lumenai. Tell us about the brand and your overall mission and value set.
When you say where are we today, forgive me.
Are you based in still in Connecticut, or are you virtual?
We're in Stamford, Connecticut.
And the brand name and the mission, tell us a bit about that before we dig into the market structure.
Sure, yeah. Lumenai, it's a combination of lumen, the Latin word for light, and AI. And it really means lighting the way or showing the way using AI, data science. And that's really our service. And that's what we are. We're a service, we're not a fund, we're not a product. We're a service for investors. And we use data science and AI to build portfolios that people want. They tell us what they want to do. We train the AI in how to maximize or optimize that particular strategy. And then from there, we turn it over to the AI, and then we all monitor it together.
Great. So it's kind of a hybrid structure. We'll talk more about that later. All right. So back to the market. So we know that with our friends and experts at Camden or Richard Wolkowitz or Ron Diamond or UBS, we know that the family office ecosystem has been exploding initially quietly and now less quietly to almost 10,000 family offices across the SFOs and MFOs, so quite mainstream, but still quite a mercurial animal at the same time. So just for our listeners today, maybe walk us through the different types of family offices between the multifamily office, the single family office, the hybrid, and then we'll move on to a bit of the wealth management side.
Sure. I think there are many definitions. So, these are just some basic ones. But your point, family offices have really become very popular, very mainstream. And that's both single family offices and multi-family offices. But we kind of think of the different types of family offices as follows. The multi-family office, where families can source wealth management to a dedicated team and kind of you get economies of scale. It's probably better for families below 200 million. Pick your number, whatever it is, but let's say 200 million or under. There's the single family office, the dedicated family office. But even there are different types. Many are administrative services, including planning, bill paying, and philanthropy. Others are investment centric. Still others really operate around a family business or real estate. And then there's a comprehensive single family office that kind of really delivers all of the services to the family. We've seen an explosion in the virtual family office, kind of family office light, which is really good for geographically diverse families or families that want to use technology and third-party services to deliver services to their family. And then, of course, there's a hybrid, which is a combination of in-house and outsourced.
Now, virtual, if we go back to like my CFO, I think it sold to Harris Bank, but there was an additional phase of virtual outsourced family office platforms. Where do you, what was that industry like, let's say 10 years ago? Where does that stand now?
I think the technology is just so much better. And I think there's so many, between cloud technologies and other services offered, things like, I think a very common example for families, for example, is, outsourcing to, for example, like Avatar for performance reporting. And with cloud technology and these kind of services, I think it makes the virtual family office a very effective option for families. And I think it's the most cost-effective option, or one of the most cost-effective.
Okay. So in terms of wealth creation, everybody likes wealth. There are different ways to accomplish it in terms of the liquid, alternate investment spectrum, and of course there's the risk profile and creating alpha in the wealth for the owners, right? Both internally and externally. So walk us through your views of the broader asset allocation spectrum and in general, your views on kind of the different asset classes and how you approach that. Moving into, what does that mean for you in terms of using AI and how you decided to shift and pivot into being more of an early mover, if you will, into AI for wealth management?
Yes. Well, I think one of the reasons why we pivoted, there's efficiency, scalability, and so forth, and we've witnessed personally, attractive results. Is many families are still kind of in analog, adopting or using analog kind of 1990s processes. Doing things manually, spreadsheets, kind of the old what I used to do, the old fashioned, go and fly out and meet a manager and do your on-site due diligence and so forth. And those are good and effective and so forth. But what we're finding is adopting data science and artificial intelligence really enables families to be, and advisors to be much more efficient and controlled and targeted in what they want to create. So if you look at the asset allocation spectrum, and if you're trying to create high risk adjusted wealth creation, there's things, of course, there's stocks and bonds, but many families focus on hedge funds, private equity, private credit, private real estate. We really like private real estate. We also like private equity, although it can be very expensive and is highly illiquid. We're a bit mixed on private credit. If you're a taxable investor, it's not particularly tax efficient and is also illiquid. And frankly, from a person who used to do a lot of hedge fund investing, we've changed our view to the point where we don't really think you need hedge funds at all. The fees are too high, the tax efficiency is too low. There's lockup skates, side pockets, lack of transparency, and plus there's the risk of a Madoff or a blow up. And the largest reason, the primary
But hedge funds have been commoditized, not just as an asset class, though, but also based on the dramatic expansion of the big institutional players in technology arbitraging their alpha rates.
I think so. I think, we used to, when we first started investing in hedge funds, we had very high alpha from it. We had a lot of excess returns, very good, high risk adjusted returns. We were super happy, very pleased. But over time, we noticed a degradation, and it just became more and more difficult over time. But at this point, with data science and AI, you can actually create your own hedge fund strategy. And you can completely customize it. You can have daily liquidity, 100% transparency. You keep it at your custodian. You don't worry about Madoff. You control how much leverage. So we just think it's much easier, better, more efficient. So that's why we say you don't really need hedge funds. If you need kind of a long short or market neutral exposure, you can create it yourself.
Mm-hmm. Now we talked a bit about also overlays for ESG, currency, tax loss harvesting. Maybe talk through a bit of the more complex elements of the portfolio construction, and then how did that lead you to create an AI platform to drive alpha?
Sure. So if you think of the kind of the base asset classes, stocks, bonds, credit, commodities, cash, you can do it long only, long short, market neutral. You can add, to your point, additional either overlays or services onto that. So tax loss harvesting, for example. I know that's a very common service or portfolio of aspects. But one of the things we really like is if somebody creates like a long short portfolio. So it's custom, they design it, we design it together with them. But once you create it, tax loss harvesting on a long short portfolio is fantastic, especially on the short side. So that's a wonderful overlay to add for a taxable investor. But you can also add things like options. You can add options for creating income, for protecting downside, and then you can also do things like currency. So with rising interest rates in different interest rate policies around the world, kind of currencies are back. And they're highly diversifying and complementary. So, and they're very balance sheet efficient. So you don't really need a lot of capital to add some currency exposure. And so you can really kind of have these building blocks. And that's really what you feel comfortable. Maybe you want something super simple, that's fine. But you can also create a pretty sophisticated portfolio as well.
So you have really a concierge type of approach where you can customize the structure for the clients. Obviously, you've got a focus on the risk, also efficiency through the tax structure, and then there's the active management and driving towards alpha. So maybe, like, what is your view on the buy and hold traditional strategy of the 60-40, and where is that thinking? Where's it going to be going the next decade?
Yeah, it's always dangerous to forecast the future, right? Because nobody really knows. However, it would seem that the coming decade is going to be a little harder to generate the returns that people want. And I think buy and hold, passive ETFs, things of that nature are fantastic bull market approaches and investments. But if we are going to be facing a coming decade, possibly longer, where it's going to be more difficult to generate returns, those are probably going to be disappointing. Those approaches will probably disappoint investors. So, our view is AI can help enhance risk-adjusted returns 3 different ways. And I think this will be very important for the next decade. The first is through active management. So we are an active firm. We are there to, increase return, to reduce risk. And through active management, whether it's through allocation or security selection, you can add value, and we would measure that through how much alpha is created or excess return. So active management is one way to enhance risk-adjusted returns over the coming decade. The other is active risk management, in particular managing larger drawdowns. So if you're passive or buy and hold, you go up and down the market, and if the market goes down quite a bit, you're going to be, some percentage of that downside. Well, that's not what we want to do. We want to be much more proactive in managing the downside. So we'll be active and we'll reallocate the portfolio. So kind of reducing the larger drawdowns is the second way. And the third way is just creating portfolios that are very efficient from a risk versus return perspective. Or think of it as consistency, the consistency of the portfolio, and let that compounding, occur over the long term. So if you can have a very efficient risk return, efficient portfolio, you can reduce larger drawdowns, and through active management, if you can create alpha or excess return, you would say over, the long term, that can add significantly to wealth creation.
It's still a hybrid model, right? I mean, you've got your systems, and I imagine that you've got a big barn of supercomputers in the back of the office, but then you, as the CEO and the staff, are still hands-on as a hybrid model. So it's really man and machine, which is it's kind of fascinating. It's kind of, ChatGPT is very useful, but then you still have to use it manually. So in our approach, in our outline, walk us through, that hybrid reality of the human judgment is still essential to be involved with the machine.
That's our view. Our viewpoint is man and machine are better together. I think most families and advisors are kind of, they're on their own. So it's kind of, the human team making all the decisions and the allocations and selecting the investments and so forth, managers. But we believe that man and machine are better together as a combination. So if you look at the people, what are people good at? Well, people are really good at figuring out what are the goals, what kind of strategies do we want, putting into context someone's goals and concerns and risk, and kind of becoming like an architect. Like if you think of building a house, the humans are like the architects, but the machines are like the contractors. And so once the architects design the portfolio, let's say the people design what they want, we think it's much better to let the machine kind of figure out how to do that. Because machines are better at crunching massive amounts of data, identifying market drivers and patterns, taking that to build efficient portfolios, manage risk, select the securities, rebalance, and then monitor. They're monitoring every day. 80,000 price points every day. And so you're utilizing the best of man and machine together.
Do you know how much data throughput and calculations are being done on your side every day? Or is there a way to
yeah, there's about 80,000. They're looking at, they're doing pattern recognition across about 80,000 data points a day.
Amazing.
And they're trying to identify what are the most important drivers. And then once they figure out those drivers, they say, okay, what are the characteristics of the securities that can do the best over the next 3 to 6 months? And then they rank all the securities that we're looking at according to those characteristics. And that's how we build a portfolio.
Mm-hmm. Let's talk a bit more about the benefits of AI, and then we can finalize. Let's talk a bit about from a fintech perspective and the financial services companies, like what's going on in the market with the big players.
Sure. There's actually a lot of benefits. I think there's so many benefits. It's really hard for like a professional investor to not adopt or at least explore some measure of incorporating AI into their investment process. The first thing, so we talked about man and machine better together, right? But AI offers a tremendous ability to personalize and customize your investments. And it really offers the ability to very tightly control what you're building and kind of the risks that you're taking, the securities you're investing in. So I think that's a tremendous plus. It's very efficient, automated, highly scalable. And it's a self-learning and self-adapting process. So, once it's built, the efficiency is quite significant. It's so significant. It will, in our experience, it will save investors and professionals a significant amount of time. We were working with one chief investment officer of a very large family office, and we estimated that we would save approximately half of the CIO's work week in terms of hours, because he was doing everything himself manually. And we kind of built and improved his process and automated it for him. And we'll save him about half his work week.
Now, you
by the way, it's very transparent. Everything's liquid.
You continue to build out for your firm as a boutique advisor, you continue to build out the AI back end and coding and algorithms and capacity, or are there increasing economies of scale as you build the AI that you don't need to continue to tweak it and fix it and enhance it because it might grow, you might reach diminishing returns of change, or it might learn itself in general in your coding? How does that work?
I think those are extremely important points. There's two things. The first thing is, I really took this from my experience in traveling the world and meeting with many of the best hedge funds on the planet. And I learned, the importance of really investing with us. There's a tremendous difference between, the top 8 players and the next tier down. And so when I was creating Lumenai, and I know we wanted to use data science and AI to create this efficient investment service, I had a very healthy respect for the difficulty involved and the importance of track record. And so as we're building out the AI, we partnered with a team that's been around for 35 25 years. And they, in our opinion, are one of the top quantitative and AI investing firms in the world. And so, they've got 60 plus staff, mostly data scientists, PhDs, AI specialists, and so forth. They're researching. They've got a very nice long-term track record. They've been through many market events. So when we were building this, we did not want to, we thought it was far too risky to try to build something from scratch because, well, it's, the risk of failure is actually extremely high. And so we could reduce that risk tremendously by just partnering with, or utilizing a group that's been proven through many crisis events and over many decades. Great. So, but to your point, innovation in the R&D has to be continuous. So things do decay, and there just has to be a continuous process of improvement and building out and new techniques and technology. And so that's a process that really should never end.
Okay. We've got 5 minutes left, so let's talk about the market and who, for the listeners that may look at the market from a wealth management, investment management estimate standpoint, and AI really exploding. So, but it's a very amorphic market and very confusing or behind the scenes. So, just I guess big picture, which of the big firms are using AI in interesting ways, or who do you admire out there that is applying it in an effective professional fashion, or who do you admire in your business?
Yeah, I mean, well, I think that the use of AI in financial services is exploding. I've seen data from E&Y and KPMG and Accenture and so forth, even the CFA Institute. Well, you'll have like statistics where 75% of major firms have identified incorporating AI into their processes as one of their top priorities. Okay, that's over the next 3 years. Definitely, yeah. And so it's banks, insurance companies, brokerage firms. They're moving very quickly to implement AI. However, overwhelmingly, they're doing it in operations, lending, and compliance functions. But there's going to be a massive upgrade of AI in those areas within the next 1 to 3 years. What you're not seeing a lot of is AI in investing, in the investment area. And the reason is because the investment area is much more complex than like an operational procedure. Global financial markets are so complicated and things are changing so rapidly. It's very difficult to create value through the investment process using AI. And so there are actually very few players in the world that we've seen that are adept at utilizing it and that have the experience in doing so. Okay. I picked a quote to reference by Peter Drucker that's interesting, related to innovation in terms of how we're looking at AI. He said innovation is a specific instrument of entrepreneurship that endows resources with a new capacity to create wealth. And he was looking ahead at the AI. I think it's still intimidating for people to really either understand it or use it, as it's both concerning and empowering at the same time. So, how do you engage in that conversation with a wealthy client that's used to more hands-on human management of their wealth into something that is behind the scenes, albeit more efficient? What's that? What are those conversations like these days? How does that work? Yeah, I think there is a very broad acceptance of the value and importance of AI. And so it has really been a tremendous acceleration in interest like an explosion of interest, and people see it as not just this kind of quirky, kind of gimmicky kind of thing, but they see the real value to it. And so the interest is significant, real, and growing. And frankly, the whole ChatGPT thing kind of just exploded the interest even more. But people see the real value in it, so we are getting a tremendous amount of acceptance. Look, there are still people that they really enjoy kind of a fundamental, hands-on, kind of a more of an analog process, and that works for them, and that's fantastic. But there's a very significant and growing segment of families and multi-client family offices and advisors that want to adopt it, and we just see interest just continuing to grow.
That's great. Well, it's certainly very exciting time, and it's a big deal to see the government step in, right, and work with the major players in the market the last couple of months and really get their arms around it, because technology does tend to move much more quickly than we give it credit for. So I wish you great success in continuing to enhance the lives and the wealth and the efficiency for your clients, and seeing Lumenai expand into a bigger business. I've really enjoyed observing the evolution of wealth management from a very more pedestrian, more traditional industry through the alternative asset explosion into where we are today. So it would be great to see Lumenai change and grow and navigate these markets. Any last words for our audience in terms of AI and your views on your vision of today?
I'll give you a quote and then just a one-liner. Ernst & Young says AI. It says 96% of senior executives in financial services say AI will redefine the financial services industry within the next 2 years. We see a lot of data like that. 96%. So we're seeing massive interest as far as what we're doing at Lumenai and the impact on wealth management. We just think using data science and AI, we just think it's a much easier way to build better, more custom, lower overall cost portfolios that take less time to manage. And that's really the benefits for families and their advisors.
I know you serve a lot of clients. You're very busy, and it's great to have your time today. That brings us to the end of today's episode. I would like to thank you, our listeners, and also extend a thank you, John, for your time and expertise today.
Well, Adam, I really appreciate you having me, and I really enjoy your podcast, and I wish you the best with it as well.
Thank you. This is Arlen Smith signing off. Stay tuned for our next episode of the Family Business Podcast.